And we're live. Phil Tarrant, Tom Panos, Real Estate Exposed. Two blokes in real estate just trying to get by, helping people be better informed, make more informed decisions, whether they're buying property, selling property, investing in property, selling the property on behalf of vendors, acting as buyers agents, managing properties, helping with finance. Tom, the real estate sector in Australia is pretty broad. I think 1 in 8 Australians are somehow connected with real estate in Australia, mate. It's at the heartbeat of this joint. What do you reckon about it? Good industry, bad industry? Sometimes you like it, sometimes you loathe it. What were you up to today, mate? It sounds like you probably had a loathe day.
No. I just got off a plane. I've been in Hobart doing some work for I think the biggest real estate company in Hobart. And firstly, let me tell you, Hobart is now for the first time seeing a bit of a price alignment, and that hasn't been happening. But their prices haven't dropped significantly. It's very, very, very light. And the reason why, Phil, is I think Hobart and a lot of areas of Australia have been they've won out of the COVID thing. They've won out of it because there is people, and I would have noticed some at the airport, but I was told by the real estate agents there's an increasingly number of people that are professionals, medical profession, finance, who actually take a plane on Monday morning from Hobart and fly to the mainland, Sydney, Melbourne, mainly. They do Monday, Tuesday, Wednesday, and they're on a plane Wednesday afternoon, and they're back in Hobart Wednesday night, Thursday night, Friday night, Saturday, Sunday. That ain't going away. That is a new norm. That is a new norm. And Hobart's not the only place in the world that's happening. But Phil, going and talking about, buyers, I think one of the reasons why I think we actually talk about stuff in a sensible way is we've got skin in the game. When we're talking about property, because listen, I've met plenty of buyers agents who actually don't own any real estate or own one property, right? So they're happy to actually give the advice, but their audio is not matching their video. We've both got skin in the game. We're impacted by what real estate does in this country and how important it is. And we're both passionate about real estate. We know that real estate can actually give you a great life. I mean, fundamentally, there comes a time when you can make money while you sleep and not have to do too much more if you actually invest in real estate long enough and actually invest in real estate doing the right stuff and buying the right properties. But would you buy in Hobart? Yeah,
I probably would, but I wouldn't now. I completely missed it. I should have been down there like a lot of people were 6 years ago, right? And Hobart's been funny because it really rocketed in growth leading up to the COVID-19, so sort of 18, 19 type of period. And then everyone thought it can't go much further, right? Like, there's got to be a ceiling that Hobart and or Tasmania will tap out at. And by Tasmania, we're talking about the sort of the regional sort of urban capitals like Launceston, Burnie, places like this, right? But then, you've just had this COVID effect where it's just gone again, which a lot of people thought there's no way in the world that it could keep ratcheting up at that rate. And some sort of economic sort of forecasters have gone, there's no more, it's overpriced. They can't go any further. But it's what you spoke about there, structural change in how people are living has given Hobart the COVID lease on life, has given it another accelerator. But it's got to now sort of dial back a little bit. I think a lot of the movement has happened. The realization, I think even sort of jumping on the plane that many times, a year is probably going to start being fatiguing to people, but it's not going to go backwards too far. The funny thing is, Tom, and I want to read this out to you because I want your considered opinion on it. Now, this is a story that I read a little bit earlier today on the great newspaper, which is the Daily Mail. You read the Daily Mail, Tom? They normally give you a hard time or use you as clickbait.
Look, they're all right. They go off social media, take photos. They don't lie, but they'll just put.
They're good for an easy story. And I must admit, I read the Daily Mail every day because it keeps me connected in with pop culture and how other sort of segments of Australia might think and operate. But great bit of journalism here, Tom. They love a property story, right? You know what's going on in property just by reading the Daily Mail. It's either slit your wrists, or it's either get out the champagne and celebrate because you're a property millionaire. There's never any sort of middling ground. But story here, Tom, headline is, how Australian house prices in some cities are plunging nearly $1,000 a day as every capital city in the country goes backwards. That's the headline. And there's some bullet points around the base of the story. And I'll read the first couple of paragraphs here, Tom. Interest rate hikes have well and truly had their impact on the cost of houses, with property prices dropping in almost every Australian region and every single capital city, bar Darwin. CoreLogic's latest National Home Value Index, released on Thursday, recorded the fourth consecutive month of plunging prices, with Australian capital cities median prices down 1.6 for August, so over the course of the month. Sydney values fell the most over the month, down 2.3% to a median value of 1.3 million, with consecutive monthly drops since April, knocking $114,000 off the median price, or $927 a day. So if you own property in Sydney at the medium level, you're $927 less wealthy every single day.
Yeah.
What's your read, mate?
Okay, there's two things. Firstly, that could be right. Secondly is...
Well, it's CoreLogic data, so it has to be right. Yeah, it's a good outfit.
Yeah. Secondly is the person that wrote that story is highly unlikely to be a real estate investor, because if they were, they don't actually keep track of your investment daily in property. What people do in real estate is they buy a property, they sign a contract, that contract then goes and sits in a drawer and may never be opened up ever again. So if you're going to be sitting down and looking at periods of times of 60 days, July and August, and say, oh, wow, I'm poorer, I got to tell you, man, you're going to end up having insomnia. But real estate people aren't like that. They're actually quite different. That's sort of the behavior you get of people that are in Bitcoin and in the share market, because they do keep score each day. They do open up the newspaper or go to the app to see what the share price is at a specific moment. Real estate people don't do that. They don't go onto CoreLogic RP data and look at their value of their house on a daily basis. That's the first thing. The second thing I get out of that, Phil, is, well, let me tell you, the main thing I get out of it is that is bloody great journalism, because coming from the media, I realize misery loves company. Misery sells, right? Of course, that's great journalism. And of course, they need the numbers on dailymail.com. It helps you with so much. It gives their sales team an opportunity to go out and sell marketing and advertising and sponsorship to people who want those eyeballs. So that's actually good work. But what it is not good for is the person that is sitting there that's trying to make a decision, and they're getting information came from Daily Mail, they're getting it from their buyer's agent, they're getting it from their broker, they're getting it from the Financial Review, they're listening to a real estate agent, and at the end of the day, they just get this paralysis by over-analysis of this information going left, right, and center. So, you know, my view, Phil, is that if you are the sort of person that is going to keep score each day on your investments in property, I probably wouldn't invest in real estate. You know? Yeah,
absolutely. But the issue you have, Tom, is the fact that the agents of the world, see, mate, the agents of the world, that is, you had Mark Bouris on your show the other day, didn't you? Oh, you were on Mark Bouris' show the other day.
Yesterday, yes, I went. I went and did a show. He's got a studio in Darlinghurst, and I think it's called Mentored Media. But what had happened is I was in Byron Bay the 2 weeks before, and it was so most of the time I've just gone there and we talk about sales, but on this occasion he wanted to get a view on the market, or my view on the market, and he's a little bit more like.
The reason why I say that, I've got his brother here, Adrian, who's also dialed in with the property markets.
Mark, and I've met Adrian. Adrian's a great guy as well.
Sorry, Adrian, this is a live Real Estate Exposed, where we talk about real estate with people right across the nation. So here he is with the one and only. I could get a little guest appearance.
Hey, Adrian, how you going?
Hey, Tom, how are you, mate?
Does your brother know anything about property?
Good to see you.
This is live, by the way.
Let's put this guy. Let's put him on the spot. Let me put you on the spot. Can I ask you right now? What do you think? Do you think the market is going to drop more, and if so, how much?
That's a good question. I don't think a lot of people don't care if it does drop anymore or not, because it's only marginal stock getting traded now. So I suppose those people do care, but anyone who has to trade now might be a bit concerned. But 90% of the people aren't worried about that because they're not trading at the moment. So, for instance, I don't really mind, and I don't want to be stupid here, but
you've got thousands of people watching it.
But at the moment, well, I understand, but at the moment, most people aren't moving. They're holding their property and it stays. So things will be fine in 1 year, 6 months, 1 year, 2 years, and they'll accelerate again. You watch every time things drop, they bounce back. So over time.
So Adrian's brought a very valid point, and this is being seen at the moment, and that is the spring blitz of listings we're expecting hasn't happened, and the simple reason is that vendors feel not confident that they're going to get their price, so they're holding off. And what's happening is there's no distress selling at the moment. There is no distress selling at the moment. Now, what I will say is this, guy. I actually did. So I'm having a look here. Lisa, though, that's talking about Bank. She's actually good friends with or acquaintances with someone. So CBA Private Bank engaged me last week and the week before to go in and do a talk on real estate and sales. And I was fascinated to find out from them that they believe there's a thing called the big event happening soon. And I said, what's the big event? Listen to what the big event is. There is more people coming off fixed loans in the next 6 to 9 months than there's ever been before. So this is what they say a big event. So what's going to happen is people are going to come off, say, 2%, and they're going to go on to, say, 4%. So they're going to get a doubling of interest rate. So really the question is, will this doubling of interest rate create distressed selling? Because I'm not seeing any of it now. And what Adrian is saying is people probably won't sell if they don't have to sell. Who sell? Divorce, health problems, financial problems, those people.
Mate, I made the point probably 3 weeks ago in this particular live show and on this podcast syndicated across real estate business that it's going to be a really soft spring selling season. I can't remember exactly how I framed it.
Actually, you did.
I telegraphed this. But it's interesting what you say about mortgage financing. And Adrian, amongst many different things, is with Yellow Brick Road, which is one of the leading mortgage brokerages in Australia, and also has a big aggregation arm called VOW. And from what I understand, and I haven't really checked in with Adrian on this, but volumes are still pretty good across mortgage financing, right? So there is, I know a lot of mortgage brokers, Tom, who are having their best months ever in this market right now. A lot of that is refinancing business because a lot of people are still transacting or capitalizing off the back of rapid capital growth that they've had, and they're repricing their mortgages, getting cashed up, getting liquid, chucking in offsets, and getting ready to go. So, when and if stock starts coming back on market, I think you're going to see a frenzy of cashed up buyers who are ready to capitalize on it. But it's all in people's heads at the moment. It's a mindset shift. You're seeing it in the rates coming out of banks right now. I think I saw a post from you on social media that there was another lender that's come out and is already starting to bring down its long-term fixed rates. So we're getting to the point. We're getting to the precipice of this particular cycle where things are going to start going from negative sentiments and rate hikes into a period of normalization and equalization. What's going to happen when that market triggers, mate? It's not going to happen this spring. I think we spoke about this last week, and we'll call it sort of March, April of next year is when you're going to get this pepped up.
And the other thing, guys, is Mark Burris said to me yesterday. Was it yesterday? No, it was the day before I was there. Mark Burris said to me the day before, there's always a lag between when the Reserve Bank makes an announcement and when it actually hits someone's pocket. There's always a lag of a few months. It just doesn't happen straight away, right? Yeah. So you've got to also bear that into account, that a lot of these interest rate rises haven't actually hit into the mums and dads' wallets on a weekly basis as yet.
About 6 weeks that it occurs with the
6
major.
weeks, is it?
Yep.
Okay, so we got 6 weeks. We got a few things. If you think about it, we've got a few things brewing. We've got the delay building up of interest rate rises. We've also got fixed rates that are coming off the ball. So there's a proportion of people that are going to be paying potentially double or even more than what they've been paying the last few years. We have no signs of distress selling yet. but that might come. We don't have a lot of listings on the market, which is probably protecting prices at the moment. So there's all these factors. But talking about finance mortgage brokers, I've got to tell you, I actually think to myself, there's a great saying. Rupert Murdoch used to say it: never waste a crisis. Never waste a crisis. And here's the crisis. Right now, I think if you're a mortgage broker, you're probably not getting the inquiries that you were getting for new purchases over the last 2 years. But what you have got is the ability to be proactive, creative, reach out, be a salesperson, right? And go off and talk to clients knowing that there's refinancing opportunities that are going to come up. And I think there are some mortgage brokers, like real estate agents, that might get devastated in this market because people aren't going to be going to them. They're going to have to reach out and go out to the market themselves.
What the interview you did with Mark Boris, this is Real Estate Exposed, everyone. This is like, you never know who's going to rock up in your office. You can have a yarn with it. It's quite unique. But what was the most poignant question he asked you? Because he would have been interviewing you, Tom, which you don't normally like. You normally like it the other way around, where you're leading the charge. What was the sort of most informed question he asked you that really challenged your response? Anything in particular that you thought about?
What I would be buying right now, what I think is good buying right now, and what properties represent opportunities and what properties don't represent opportunities. The ones that don't represent opportunities is if you go off and participate in a bidding war for one of these beautiful like stunning architect design homes, you are still competing against buyers, because there's a lot of buyers who don't want to participate in renovating anymore because of inflation, building materials, labor's hard to get. They don't want to go off and do a fixer-upper anymore. They used to. They'd rather go off and pay top dollar for something that's renovated so they're not caught up. What I would potentially buy is a unit. And the reason I say it is units got smashed during COVID. People were petrified that we were going to have this New York scenario where people are going to be sick and dying in blocks of units because they've got no ventilation. So there was a bit of an exodus from units. No one wanted to touch them, right? So the gap between houses and units grew. Now all of a sudden, where people realize, I'm not going to die. I've got a vaccine. COVID looks like it's coming to its final stages. So what people are saying is they're turning around and saying, wow, units are representing good value. So unrenovated units that a lot of people weren't touching, you're probably getting at a good price. He also said to me, that's another question which was hard to answer. He goes, should you buy now, or should you wait another 6-12 months after the rates keep going up? And my response was that in 35 years of real estate, one thing I've learned: when you wait, when it picks up faster than what you thought it does, right? You wake up one day and then you realize, oh shit, it's got up. But guess what? It's too late then, because you're going to be buying more than the bottom. So I reckon it's safer to be buying on the way to the bottom. Sorry, Adrian.
You can't pick the bottom.
You can't, because the only way you've got certainty on the bottom is when the market's gone up, because you can look back and say that was the bottom, but by that stage it's too late. You won't be buying at the bottom. So I reckon it's safer to buy as it's going down. So you miss it by 5%, you miss it by 7%. Whoopie-doo, you're going to keep it for 5, 10, 15 years, and chances are you're already saving 10% anyway. So you are ahead because you're buying while it's going down. Don't ever buy real estate based on the market. Buy it based on your family, buy it based on your lifestyle, buy it based on your cash flow, but don't buy it on the market. You're going to be really disappointed.
You're going to put a lot of people out of a job, Tom, especially guys like me who talk about real estate markets. Well, what are you doing to me, mate? And by the way, is whoop-de-doo a real estate term?
Sorry?
Whoop-de-doo. Anyway, no, it's good. So
give us a question. What would I do if what real estate terms?
No, whoop-de-doo. You spoke about anyway. So we've got one of the lead.
You've been brought up in Belmore, right? That's what you get when you've been brought up in Belmore.
That's right. Now we've got one of the.
Adrian knows that he was brought up in Punch Bowl.
That was pretty close.
Guys at Punch Bowl. Yeah, we got one of
my first property I ever bought, Victoria Road, Punch Bowl. It
Is
was.
that right?
Yeah, it was this. It was the second. The street where all the trouble was Tilapia Street, right? And then there was Victoria Road. But look, every winner has got to become a beginner. You don't buy. I remember buying that property, and the guy, I said to the guy, there's a mentor. Let's call him a mentor. I said to him, I don't like it, George. His name was George Pappas. He had about 150 houses, right? Marrickville, Enmore. He was one of these old Greeks that kept buying cheap homes, floorboards, polish and paint them, used to put tenants. I said, but George, I don't like the property. And he looked at me, he says, you don't have to like your first property. You just buy it, you know?
Now, Tom, we've got one of the sort of most undercover leading minds in mortgages here joining us ad hoc in this particular live stream, Adrian Burris. Adrian, so we're going to interview Adrian here, which is probably going to make him pretty uncomfortable. How are market conditions shaping the way in which mortgage brokerages are building their business right now? Is this like Tom's saying, is largely irrelevant, or you get continuity with it over time, or are you shaping how you're maneuvering your mortgage business around the market itself?
No, we're not worried about the market at the moment. We are recruiting as usual. We've got 6 to 8 new recruits sort of going through different processes at the moment in terms of franchises. In terms of funding, I'm full steam ahead on our funding business. That's where we're acting like a non-bank and our brokerages are selling our loans. We're full steam ahead with that. That's now $350 million portfolio, and we hope to grow that to close to $1 billion within another year and a half. That's full steam ahead. So you can't wait for the market to either change up or down. Otherwise, you just got to keep getting on with business. And we're bullish over long-term property. You look at 10, 20, 50, 30 years, whichever period, it's just, the trend has always been up. You look at, the outstanding mortgages that the RBA publishes, it's just one way that way, right? That's published every quarter. And you look at it back for the last 30 years, every single quarter it's increased. So, this volume of stock just keeps growing. So, and then that's the same with property. I mean, obviously mortgage underlies property. I just want to go back to one more thing that Tom was saying before, and I may or may not be typical of the normal borrower. I have a mortgage, and so I am concerned about it. I'm not so concerned about my repayments at the moment because, one, I'm well ahead. Two, I'm not heavily geared. Obviously, three, I've got income, but again, when everybody took these loans out, there was buffer rates in place. So, we had a large buffer, and applied to us. And in our own lending business, we put buffers in the serviceability calculations. And we have a 2.5%, and most have a 2.5% to 3% buffer. So that's on top of the standard variable rate. I mean, it's pretty large. So we've already taken a lot of the banks, and even the people who have taken out loans in recent times, that they've had, who may be the more vulnerable, you might think, in this current market, they've had buffers applied to them. So again, Shiraz and Wagyu case, what do people do when times get tough? They tighten their belts, move on, and we all do that. We all adjust our lifestyles. So
the Reserve Bank Deputy Governor had put a paper out probably about three weeks ago now, pretty much sort of talking about the strength of the average Australian borrower's balance sheet, probably, a similar situation, Adrian, quite ahead on their mortgages, Tom. What are real estate agents saying to you in relation to this, and the people knocking on their doors is expectations around prices on vendors starting to become more realistic, or are they still holding on to what it was 6 months ago? Is it getting easier for agents to list property at its right value, and vendors absorbing or actually appreciating that's where the market is right now?
Well, let me tell you, the real estate agents of Australia should go off and take annual subscriptions on every media, on every newspaper, because as far as I'm concerned, the Australian media has to be the vendor manager of the year. They have made jobs so easy for real estate agents at the moment. I'll give you an example. I'll do on average 10 auctions on a Saturday, my auction. I ask this question. This is the first question I ask the vendor when I meet him. So the door's open. Hi, I'm Tom. I'm the auctioneer. Hi, how you going? This is my first question. What's your understanding of the current market? 99% say it's not good. Next question. Can I ask you, do you think the market's going to go up in the future or down? We think it's going to go down. I already have vendors who tell me themselves the market's not good and the market's going down. The media has done this. And what it's done is it allows people to collect information in the moment because of this mobile phone. We used to wait for the 6 o'clock news. We now have got the 6 o'clock news every minute on our mobile phone. It's coming through notifications. So it's not that hard, guys. I've got to tell you, real estate agents are not finding it difficult to get vendors to accept the reality of the market. The ones that are difficult are the vendors who went onto the market earlier on, back in January and February. They're the ones that keep saying, oh, but we just missed it. We missed it by 2 months. So they're the ones that are a little bit more challenging because they had actually often, believe it or not, they'd bought when prices were high and they hadn't sold their property. So they've been caught up a little bit because they actually transacted in 2 different markets. They bought during a strong one and they're selling now in a softer market. They're the ones that are a little bit more challenging, right? Or I had a classic one. I just had a vendor meeting now for an auction on Saturday. The people have owned a home for 52. Oh, wow, what a coincidence. It's actually in Greenacre, so it's not far from Punchbowl. And the daughter said, Tom, we're not buying another home. They're just selling the home after 52 years. And if we don't get our price, that's okay. We've had it for 52 years. What's another few more years? So there wasn't any signs of them. Tom, we have to sell it because we can't make the loan repayments. There's none of that, you know.
Yeah, you know what? We've just gone full circle back to Adrian's initial point that, you know, only people aren't selling because they don't need to sell. It's only the fringe stock that's having to sell. Now, fringe stock largely is distressed or reason for it. Tom, mate, we've had a special guest, an impromptu special guest today. We should feel quite privileged. That's for you, mate. That's back-to-back Boruses over 2 days, mate. So there you go. What a punishment. You should be getting you're certainly doing your civic duty, mate.
Mate, he's one of. Listen, he's obviously not as visible in the world of media, TV, or social media as his brother Mark. But I have been told by many people he's a brains trust when it comes to the world of finance and mortgages. And I could say. And by the way, Adrian, I've been getting pieces of content where I can see that Yellow Brick Road is on a big drive on recruitment and training as well. I think they're training the brokers to 2 areas: their recruitment and education.
Well, you've got one of the best training programs around, so no problem.
Yeah, look, and he's smart enough to get a plug in as well, which is this supposed to be advert-free Real Estate Exposed. And thanks for everyone tuning in. So this is Real Estate Exposed, where myself and Tom go behind real estate and have those conversations that most people can't have or won't have. And Tom, again, a very informed discussion. I'd score us pretty well as we've navigated this COVID period and now extrapolating out of it into a rising rate, inflationary hiking, wars in Europe, all the stuff that we cover off on this very wide, broad, ranging discussion, Tom. So we score us pretty well. We largely get a good. Let's see if the Phil Tarrant, you know, you try and pin me down on stuff most of the time and I never give it to you, but I'm still leaning towards a really soft spring selling season, mate. We'll wrap it up at the end of spring and see how we go. You mentioned it last week or the week before, and I said to you it was early days, but I think you could be right. I'm getting auctioneers texting me every day. Tommy, you want a weekend off? I'm free. Tommy, any way I can help you this weekend? So there's not as many auctions as what was forecasted, and that's purely because I think if they don't have to sell, they're hanging on to them. There you go. Well, Tom, thanks for your time today, mate. Always enjoy catching up.
Thanks, guys. See you, Adrian.
See you.